All right. I think we'll go ahead and get started. Good morning, everyone. My name is Reed Myers. I am the principal of Myers Investment Group and Myers Capital. And today we'll be going over how to use basically passive mortgage investing as a complement to your existing portfolio. The goals here are basically to kind of go over from an educational standpoint. I know some of our attendees here are existing clients and maybe prior attendees on other webinars. Some are existing investors. So we'll try to kind of hit all angles, both from just an introductory level as well as digging into a little bit more details and how we see the market performing right now and some of the deals that we've been working on lately. We've got a very special guest today. We've got Jack Malpass. He's with Next Generation Trust Company. Next Generation is a self-directed IRA custodian, and he'll be going into a little bit more details on the mechanics of how a self-directed IRA works and see if that might be a path that makes sense for you folks as an investor. So we'll go ahead and get started. I do see some new names here, so I'm kind of curious. If any of the attendees, if you don't mind, maybe just type in the chat there. If anybody's familiar with alternative investing, such as private credit, mortgage notes, real estate syndications, things like that. And I'm also just curious if anybody currently has an existing self-directed IRA. That kind of help me give me some direction on where to take this meeting. Okay, so of course, got some disclaimers. Just a little bit quick background on me. I've been in the mortgage industry, lending, capital management for almost 20 years now, or a little bit over 20 years. And I originally got started, I was actually originally from Hawaii, but I grew up in South Carolina and then came back to Hawaii to open up a branch of our family company, Myers Capital, about 15 or so years ago. And my first foray into real estate kind of finance world has been in working for a real estate investment trust in the Carolinas. I was an analyst and I worked for the chairman of the company in a lot of the real estate investment development projects. I did retail repositioning, business acquisitions, and things like that. Fast forward, Myers Capital is a family-owned company, been around since 1998. My father started it, and when he retired, I took over and ended up expanding it out to Hawaii, which is where I'm currently at. So beautiful Honolulu, Hawaii. And over the years, I've had various licenses, real estate appraiser's license and a mortgage lending license across multiple states. A little bit more background. Of course, you can go search all this, but we've been fortunate to be featured in Pacific Business News Hawaii, as well as Mortgage Professional America. Just regarding, a lot of it had to do with operationally, how are we dealing with the changing times, both from, dealing with technology, AI, remote work. I think the appeal was for this particular journalist that reached out to us was, how do we do what we do kind of all from Hawaii? And that was a really interesting conversation we had. So if you have time, maybe try to check that out. A little bit of the basics on our company. So we provide secured real estate investment opportunities for accredited investors. And our focus obviously is passive mortgage investing. And the goal here with passive mortgage investing is to provide consistent secured income. And basically these private mortgages are used by our borrowers to help with acquisition, refinancing, ground up construction, anything to do with their commercial or residential real estate, all non-owner occupied. And basically, we bring in our decades of expertise in the mortgage industry to both provide a good product for our borrowers as well as good opportunities for our capital investors. And basically, I always talk about with our team and our clients, like, what is our mission? Like, why do we do what we do? On Myers Capital, our mortgage side, we help everybody from actually, first-time home buyers, consumer borrowers, as well as sophisticated high net worth real estate investors, and then of course our capital investors. So our whole goal with our companies is basically, how do we have clients for life and like on both ends of the spectrum? That's our goal. And the way we deliver on that, we're a small boutique company. It's very white glove, very hands-on, personal customer service, designed to really be there and telling you with open, honest opinions, like, is this loan good for you or not? Or maybe you might want to check out this other company to see if that makes better sense, because that's maybe not really our expertise. And it's the same thing with capital investors. I've had investors that seemed interested in what we were doing, but when peeling back the layers of the onion, we really realized that, and I told them that this doesn't quite make sense for you. So for us, that's important, having the right framework from the start as to, whether or not it's good for you. That's the main thing. And that's very important to how we operate. So we talked a little bit about Myers Capital, Myers Investment Group. Myers Investment Group is just our capital management side of our company. Myers Capital Hawaii is our mortgage company. Some stats on us, we've originated over $1.5 billion, been in business since 1998. We land in about 44 states, depending on the asset class. And we do it all from Honolulu, Hawaii. We have staff here in Hawaii, staff in California, and in Texas. But with the beauty of technology, we're actually able to operate, throughout the country. So it's really amazing the way things have evolved and come over the years. And we've been very fortunate with great clients to win awards kind of across the country. So we're very, very appreciative to everybody for that and happy. All right. So I always like to start with, okay, where investors are right now and how we can actually help alleviate certain pain points that they might have. And usually one of these pain points might start with active real estate ownership. So this is not to be misconstrued as, we are against active real estate ownership. In fact, it's the opposite. A lot of our clients, a lot of our investors, even myself included, we've done very well learning about real estate ownership, and that's helped get us to certain levels in life. And there's nothing wrong with that, right? Active real estate ownership provides a lot of benefits. Some of the problems that we see is over the years, it starts to take a toll on kind of your time and your ability to manage and just the headaches of going into managing that real estate, even if you actually have property managers involved. So we see that a lot. A lot of complaints we see are, it's time consuming, it's expensive. Maybe my ROI has gone down because maybe the property is fully depreciated. But other things, as far as when you grow the equity in your real estate, your ROI tends to go down without relevering it. So sometimes it makes sense to disposition it. With the public markets, of course, you have market volatility. And many of our investors are getting to a point where they're looking to, okay, we built up all this appreciation and equity within our real estate. And now I want to start living off of it or enjoying it and start to dial back instead of having a part-time job, managing my real estate. And that's kind of where we come in. So yeah, a lot of this is actually kind of what I already said. And so real estate, great investment. But if you're thinking that you may want to take some chips off the table, there's some strategies that we can put in place for that. Stock heavy portfolios, the ability to liquidity is there with stocks, but what stocks don't and public securities don't really address is when you have to start taking capital out of your accounts, are you going to be in a downturn, right? And that can severely impact your ability to live off of or actually have the income that you're looking for. So really, a lot of it comes down to when things start to change in your life. Is the investments that I'm currently invested in, are they right for me at the stage that I'm going through right now? Right. So passive real estate or passive mortgage investing is a way to be involved in real estate without all the headaches, the management, still be involved in real estate, being able to use that as collateral. And that we'll talk about that. So the protection of your downside, but it's going to provide a lot more predictable income than you would get otherwise. Okay. So here we'll get into a little bit of some examples. So sometimes I talk to investors and a lot of them, they say, really, Reed, I'm not looking for more upside. I'm just looking for predictable income with defined risk. I couldn't really say it much better. That's perfect for passive mortgage investing. So it's not about knowing everything at any given time. And it's not about maximizing and absolutely hitting home runs and everything. It's about predictability. So we've had a client, this is a kind of a particular case study where he owned investment property for years. This actually property was in Hawaii, and then condos in Hawaii were experiencing an issue with HOA fees, or as we call them, maintenance fees going up dramatically. That has to do with insurance costs going up dramatically. We had one client, and I've seen this across multiple situations. He had fully depreciated the property. His rents have not increased that much. The maintenance fees have gone through the roof. The property taxes have increased quite a bit. And he owns it free and clear. So he's sitting on significant amount of equity. And he's looking at, should I sell this? Should I do another 1031? If I do a 1031, I got to take out another mortgage. The advantages of doing a 1031 exchange, obviously, he gets to kick the can down the road as far as his capital gains. So some of the solutions that my clients have explored are, you know, biting the bullet. Let's just sell the property, cash out. Once you do that, you also have to figure out what are you going to do with your cash, right? We've also had some clients when they fully depreciated their property, but maybe they didn't want to sell and take the hit on capital gains. They just relever it. So, AKA taking out on a new mortgage. So the challenge with that part is, you take out that cash, you might be able to put that cash back into the property if that's your goals, or you can invest it. We've had clients do that. You just need to do that carefully and obviously look at the spread between the capital that you're taking out and your cost of capital on that as opposed to what you can earn. So right now, on average, we're earning about anywhere from 10 to 12%. So this particular client is actually in the process of liquidating his condo. He's expected to walk away with about 500,000 after capital gains and real estate fees. And so basically, we ran the numbers for him, and he's very comfortable being able to take that investment and invest it with us, and he's going to earn about 55 grand a year on it. So that's a very common situation. With retirees, similar, right? A lot of it has to do with timing, both timing for yourself as well as timing where you are with your current stock portfolio. So right now we have the advantage of stocks are actually up right now. The markets are doing very well, but it's kind of one of those things like how far is this going to continue? How savvy are you in readjusting what you have there to be able to take into account potential downturns at a point maybe in the future or very near future where you're going to need to start taking that money out for income. So I always say too, like direct mortgage investments, it's not about timing. It's about structure and certainty. That's really what it provides. Because if your problem is income can solve problems that appreciation cannot, right? And that's one of these things that you kind of see time and time again. So lack of stability, lack of consistency. Again, nothing against public securities. I have portfolio in there as well. These are just things to point out, pros and cons. We've had clients, many of them who are retirees who have IRA accounts that you can invest money from your IRA account with us and create stable monthly income. You do need to put it into a self-directed IRA, which is why we have Jack here to go over all that and kind of go over the details. All right. So passive mortgage investing, basically getting into the nuts and bolts of it. Basically, it's a way to earn consistent monthly income. I'm going to have typically higher above market risk adjusted returns. On average, we're averaging like 10 to 12% returns. And all of this is secured by real estate. So you got to think about it. When you invest in these investments, you're basically operating as a lender. You are the bank, right? So we're lending on real estate assets, hard assets that have value. And we'll talk about how those get structured. So the core of our strategy, of course, is real estate. Our average loan to value across our portfolio is about 50 to 60%. So on average, like you take an average single family home on Oahu, $1 million. On average, we're lending somebody $500,000 to $600,000. So 50 to 60 cents on the dollar. These are short-term loans, typically 6 to 12 months, and they typically get paid off maybe every 9 months to somewhere around there, maybe 12. So they're relatively short-term. These aren't 30-year loans. The commitment level is not that long. Because of that, this kind of creates a semi-liquid type of investment. A lot of these, like we talked about, they're going to be across residential and commercial real estate. So residential, 1 to 4 unit properties. So single family to 4 units, multifamily, which is 5 units on up. And then we also lend on selectively on commercial real estate. That would be like mixed use properties, some retail. We are very risk averse with office right now, even though a lot of the issues we see in commercial real estate and office is on the much higher end of the scale. Our average loan amount is maybe $1 to $2 million. So we're lending on properties, typically $5 million or less. So we're not seeing that big effect the way you read about in the headlines about office space and office towers being delinquent on their debts and things like that. But it's something to be aware of. But we are very, very light on office space. Right. So who do we lend to? Like who takes these types of loans and who are our actual borrowers? Why do they come to us, right? Common question I also get asked is, why are they willing to pay the rates of what you're proposing here. Our average note rate on these types of loans. So note rate is different from the rate of return that our capital investors are going to earn because we're going to make a spread, right? So typically the way the loans are structured, our average note rate is maybe in 13 to 14%, and our capital investors will make usually 80% of that. So why did they come to us? Why is somebody willing to pay that? A lot of questions I get asked about, why can't they get a loan from the bank? What's wrong with them, right? So the thing about lending with traditional bank lending, agency lending, right? Fannie Mae, Freddie Mac, 30-year fixed loans. It's all about both the borrower, the ability to repay, and also the collateral. So let's talk about borrowers for a minute. Credit scores. Anybody who's in the mortgage industry understands that credit scores don't always paint the correct picture of your borrower. It's very black and white. I've seen people that should have excellent credit. They've had very, very little debt over their life. Maybe that's the problem. They have FICO scores in the low 600s because they haven't taken much debt out, right? So the history isn't there. It doesn't mean they're a bad borrower. Sometimes they've had excellent credit scores until maybe credit cards have gotten maxed out and they're going through maybe a transitionary period. Maybe they're a real estate investor and they had to use some of their own. They're trying to do a project with some of their own cash. So their credit cards got maxed out and all of a sudden their credit scores went from 700 to 600. So we've seen that. So most of the time sometimes it's credit related and sometimes it's the collateral. So real estate will always have some sort of intrinsic value, but if the property isn't in very quick marketable shape, most long-term loan will not work on it. So I'll give you an example with properties with maintenance issues. So in Hawaii, these are like the common questions I ask for a borrower when they're trying to get a loan. So tell me about the condition of the property. Is there any wood rot, termite damage, peeling paint, foundation issues? And they say, well, it's old. It's a fixer-upper. That's why I'm buying it. And the soffits are rotted out and paint's peeling, but that's why I'm getting a good deal on it, Reed. Let's just say we're talking about a real estate investor. And I say, okay, great. So as soon as he told me that, I automatically know that no matter how good his credit is, no matter how great his income is, the property will not work for a traditional long-term agency or bank loan. Automatically, we're going to have to go into some sort of private bridge loan, private money world, hard money loans, whatever you want to call it. They're all kind of bundled together. So that's a common example. We're really lending on the asset itself. So there's always going to be some sort of intrinsic value there, especially in Hawaii, where a lot of our value is built up in the land. And we overcome some of the issues that we say okay to by just stringent underwriting and other aspects. So how sophisticated is the borrower in turning this property around? What are their liquid reserves? What's our worst case scenario, right? So, let's just say the property worth as is because it's in bad shape is maybe, let's just say $500,000. And a borrower is going to come in and put in $150,000 and fix it up, and then they're going to sell it for $8,000, right? That's a common example. Well, even when the borrower comes to us for that $500,000 purchase, we're not going to lend them $500,000. We're going to lend them, maybe 60% of that on average. So there's already built-in protection there. So that's a big part of one piece of, an example of who we lend to and how we kind of overcome that to make sure there's still solid principal protection for our investors. Now, on top of that, we manage the loans in-house, collecting the payments, working with the borrower to work through any kind of construction draws, things like that. It's a way for us to kind of be involved with the property, not just to closing, but after the fact. Okay, so how does the process work? So it's pretty straightforward. First thing I always like to do, the whole point of this webinar is to kind of give people an idea of how passive mortgage investing works. But I still like to have personal suitability calls with my borrower or my investors. So that is pretty much just a Teams meeting, or we can meet in the office if you're here in Honolulu, or we just have a phone call. We go over your goals. Yeah, I understand a little bit more about your investing experience. We talk about your accreditation, if you're an accredited investor, and how that works. If it's something you're interested in, then you basically get put on our list, and you'll see deals, opportunities come available. If you're interested in it, select it, and you let us know. We'll get you to sign an NDA. Then we send over the due diligence. Due diligence package includes, everything we did to underwrite the loan, appraisal, loan application, credit reports, everything. If you want to invest in it, then you sign the investment agreements and then you wire your funds. Then, of course, you start receiving your distributions. Estimated annual returns, 10 to 12%. That's net to our investors. So that's after any management fees that we take out. Like I said, we typically take a 20% management fee and whatever the note rate is. Most of our loans are averaging around 11 net to capital investors. So our note rates on average are about 13.75. That's how we get there. Most of the terms, around 6, 9, 12 months. Most of them get paid off within that time frame. They have to pay us off by the time the term ends. Otherwise, the loan can go into default. We can kind of talk about that as well. And distributions on these direct investments are typically monthly. So interest guarantee. I was talking to a very sophisticated investor the other day, and he was telling me, he gave me this great quote. He said, sophisticated investors don't chase returns, they design outcomes. And that really hit home with me because it was something that I never really put it into actual words like that, but it's something that we're always going through every time we're structuring a loan for a borrower. So there are different levers that we can pull on when we structure loans. So some are very obvious: the term, the rate, the leverage. How much of a loan are we lending them? There are a myriad of other levers you can pull, and it's all really negotiable. It's negotiable between us and, of course, the borrower. One key feature that we like to build in, because these loans are so short term, some investors of ours, they like the fact that it's short term, right? That fits with what they're looking for. They like the idea of earning 11% and then being out once it gets paid off and then looking for a new deal. Some say, wow, that's 12 months is too short. So you can't please everybody, but this is one way to kind of appease that side of things and say the short-term investment is like, well, Reed, I don't like that because I have to, as soon as it gets paid off, I got to look for another deal. Or maybe it's a short-term loan already, even shorter than 12 months. Maybe it's 6 months and it's not worth it for me to go through all this, invest my money. And what if the borrower pays me off early? One lever we can pull on are what's called guaranteed interest. This doesn't mean you're guaranteed to make a certain amount of interest because the borrower can always default. That's always a possibility, although it's very low. Side note, our default rate is typically 1% to 2%, but it's a way for us to build in, especially on really short-term loans, that we're going to make a certain amount of interest regardless of when he pays us off. Basically, it's a prepayment penalty. So like on a 6-month term, for example, we might say, we're going to do a 6-month term, but we want to guarantee that we're going to earn 6 months of interest regardless of when you pay us off. So prepayment penalty, the borrower has to pay it. If the borrower pays us off in month 3, we're still going to earn 6 months of interest. So your annual yield goes through the roof if that happens. That's not the goal. The goal is just, is it worth my investors' time, my capital investors' time to do this? And I understand, Mr. Borrower, that you only get this money for a very short period of time, but we have to go through so much just to put this loan together, just to arrange the capital, to start servicing the loan, managing it, underwriting it, that I need to make it worthwhile for my capital investors to do this. And in order for me to lend you the money, we're going to need this feature built in. So that's kind of how the conversations go. I thought that was a really great way. I saw that quote. I was like, I need to put this in there. All right. So investment size, typically direct investments, we're looking for minimum investments of 150 to 200,000. It depends on the deal. You do need to be accredited to do this. Accredited investors essentially means that you have an annual income of $200,000 a year if you're individual or filing separately from your spouse, or $300,000 a year if you're filing jointly with a spouse. And it needs to have continuity to it. There has to be a good expectation that it's going to continue, or you need to have a net worth of at least $1 million, excluding equity in your primary residence. Most of our investors here are going to be individual investors, not institutional. But side note, if this is an institutional investor, you do need to have assets in excess of $5 million. I had a conversation with my attorney yesterday, securities attorney, about the new accreditation rule that came out earlier this year. So basically, if you are investing at least $200,000 or more, you do not need to be what's called a verified accreditor. The SEC is essentially saying that they assume that you are sophisticated enough, if you're writing a check of that size, that we do not need to actually verify your accreditation. So if you're investing less than $200,000, you do need to be accredited, and we need to verify it. Verification comes from a letter from your CPA, financial advisor, or attorney stating that they reviewed some documents and they are stating that you are an accredited investor. You can also go to third-party vendors. There's a myriad of them available for a fee. It's not too much, but it's basically they're going to review all your documents and give us a letter that allows us to have on file for our SEC compliance. Okay, so what kind of accounts can you invest in? Obviously, cash, checking, savings account, self-directed IRA, 401ks. If it's sitting with a 401k, very likely you can't invest directly with that. You need to take it out of the 401k. Whether or not you can take it out of the 401k, usually if it's an old employer, you can take it out, right? But if you're still with the employer and that's your existing 401k, most of the time you're probably not going to be able to invest directly with that because most company 401k plans don't provide that sort of language that allow you to go manage your own money. They want to keep it in that bucket. You could borrow against it theoretically. I don't always recommend that, but it's theoretically something you could do. Of course, you can liquidate stocks and bonds. You can also borrow on margin on stocks. Lines of credit, again, be careful whenever you're levering money to go and invest with us. Even if you're going to get a margin, you have to be aware of the downsides. Some investors that still have very low HELOCs in the 2 or 3% range, they've borrowed on that at 2 or 3%. They've invested with us at 11, and they're making the arbitrage of the margin on it. Again, sophisticated approach. You have to be aware of it, be comfortable, and understand the risk. Traditional or Roth IRA, same thing, convert it to an IRA, still tax deferred or tax exempt, depending if it's traditional or Roth, and you'll get all those tax benefits if you bring it over to a self-directed IRA and then instruct them to invest into our investments. All right, so we'll go ahead and introduce Jack. Just kind of give you a background on Jack. Jack has been with Next Generation Trust for about 15 years. He is an account executive there. Basically, his job is to provide value to his clients as far as structuring, setting up self-directed IRAs, being there from the service standpoint, helping them get onboarded, opening accounts. Jack's passionate. Has been over more than 8 years as a sales trainer in a sports eyewear company, and he holds certificate of computer tech support from an institute or Chubb Institute and earned a self-directed IRA professional designation from the Retirement Industry Trust Association. So Jack, you can go ahead and take over.
Appreciate it. Thank you, Reed. Hello, everybody. Nice to meet you all. Like Reed said, my name is Jack Malpass. I am the business development specialist here at Next Generation, and my job is to educate investors on how to use their retirement money to invest in alternative assets. We've been in business for over 21 years. We are the administrator custodians of self-directed IRAs, and I will give you a short presentation on how you can invest using your retirement money in a self-directed IRA. A little disclaimer, we are not fiduciaries nor advisors, so the information I provide is for education only. With any investment comes risk, so it's best to always check with an accountant or a financial advisor as to whether the risk for the investment is worth it, or you can take the downfall or the upswing of any investment. So what is a self-directed IRA? So a self-directed IRA is different than your regular IRA in that your regular IRAs, whether it's a traditional Roth, SEP, solo plan, they hold publicly traded stocks, bonds, mutual funds. A self-directed IRA, we hold anything that's not publicly traded. And we'll go over what some of those things are. But that's what differentiates us from your regular IRAs. Your regular IRAs won't let you invest in alternative investments. So that's why companies like the self-directed IRA custodians have been around for quite a while now. Gives you the opportunity to do things outside of your regular investments, and also helps with diversification of your assets. When the stocks, bonds, and mutual funds aren't doing well, this gives you an opportunity to diversify and do something that's outside of that realm and still find a profitable investment to do. These are the types of self-directed IRA retirement plans that you can use to invest. Basic ones, your traditional and your Roths. For self-employed people, you have your SEP IRAs. You can also do a solo K plan. Covered L's for kids' education. Health savings plan for people who want to invest in HSAs, and it goes all for medical expenses. For anybody who has someone who's passed away and left them an IRA, you can do a beneficiary IRA or what's called an inherited IRA. So these are the different types of plans that you can use to self-direct. So these are the options of how to fund a self-directed IRA. First one is contributions. Contributions right now are $7,000 if you're under 50, $8,000 if you're over 50. In a month from now, they will be going up. So contribution is going to go $7,500 to $8,600. Okay, keep that in mind. Transfer, if you have an IRA or a Roth with a custodian, and you want to keep it the same way, you can do a transfer, two like accounts. There's no tax implications because these are two like accounts. So transfer are traditional to traditional, Roth to Roth. That's what a transfer is all about. A rollover, pretty basic with a rollover, 401k. Like Reed said, if it's not an active 401k, you can roll it over. You could also do IRA rollovers. Just remember that IRAs, you can only do rollover once every 365 days. So a 401k, you can do it as many times as you want, but the IRAs are only once every 365. A lot of people like to do this also, becomes very popular, is doing conversion. You have a traditional account and you want to convert part of it to a Roth, where you're going from a tax deferred account to a taxable event. That is conversion, or another word for it is backdoor Roth. So this is also a way you can do it.
Just a quick question on that last one about rollovers. I'm just curious about that. So you can only roll over one time a year from a particular IRA account. Is that right?
IRAs can only be done once every 365.
Okay. But if you have like multiple IRA accounts, each one stands on its own, correct?
We can only do one of them as a rollover. I can't do
Oh,
both.
really?
Yeah.
Oh, okay. Good to know. Thank you.
You can do transfer. If you're transferring two like accounts, you could do that as many times as you want. So you could transfer Roth to Roth, traditional to traditional, as many times as you want. But some people do rollovers, which is fine. You could do a rollover. You can only do it once.
When they're taking, is that considered a rollover when you take it from a traditional IRA to a self-directed IRA vehicle? That's a rollover, right?
Or you could just transfer.
Oh, really? Okay.
Yeah. Your regular traditional IRA is the same as it would be with us. All the rules apply. Same thing, contributions, distributions, everything is the same. That's why if you do a transfer of two like accounts, there's no tax implications because they're both traditionals. It's just considered a self-directed traditional IRA. Some people do rollovers because they don't know that they can transfer. So if they want to transfer, they can do as many times as they want. They can transfer all over the place if they want. But the rollover is only once every 365 on an IRA. 401ks are different. You could do that as all you want.
Got it. Oh, makes sense. Thank you.
Yeah, no worries. And again, if you want to do it traditional and you want to roll it to or convert it to a Roth, you can do that also. People open traditionals and take a partial conversion. They start doing it a little bit at a time. So these are the just different options that you can do. So here's just a small portion of the things that you can possibly do in a self-directed IRA. Okay. Real estate. All these investments or any investments that you can think of has to be a new investment. It can't be an investment that you already own in your own name. If for some reason you may have an investment with a different custodian and you're not happy with them, you could always transfer in kind from custodian to custodian. But all these investments have to be newly formed investments. Real estate, investment properties, syndications, joint ventures, single family, multifamily, fix and flips, buy and holds. You could do mortgage notes, tax liens, private placements, pre-IPO, hedge funds, syndications. Reed was talking about lending. You can lend money to other people. You have to be very careful when it comes to friends, family, because there are IRS rules on who you can and cannot do certain transactions with. But that's part of my job, is to educate you on who you are doing arm's length transactions with or any kind of transactions with. This gives you a way to diversify your portfolio. If you're doing stocks, bonds, and mutual funds, and you want to do something other than that, this is some of the different types of investments. Now, again, these are small portions of things you can do. Whatever your brain can come up with that is not publicly traded assets, life insurance, collectibles, or cannabis. Those are the things that can't be held in a self-directed IRA. But again, anything on here, or if you have something in mind and you want to run it by me, give me a call. I will let you know if it's something that can be held in a self-directed IRA. So, other thing, this is tax advantaged. By using your IRA owns these investments. You do not. So whether it's a tax deferred account or tax free, you're getting the tax benefits of using your retirement money instead of your regular money from out of your checking account or your savings account. But again, you have to have some type of retirement plan. You have to have the money in the retirement plan to be able to make these investments. Again, potential higher for returns. These are your investments that you go and find. Okay. Next generation, we don't have a portfolio to choose from, like you do with your regular investments. It's not high, low, medium risk. You go out there, you talk to the investors or whoever you're investing with, find out what the return on the investment is. How often do I get a return on my investment? So you do all the homework. You just come to me with the idea or that this is what I'm looking to invest in. And I let you know, yes, you can do it. No, you cannot do it. And I explain to you how it can be done. Okay. Last step, like I said, control over your investment decisions. You are the one in control here. Unlike your stocks, bonds, and mutual funds, you make an investment that you know what you're going to get. You know if you trust this person that you're investing with, and you know what type of returns you're going to get. Okay. So again, these are just some of the different types of investments that can be done in a self-directed IRA. If you have any questions, let me know. We'll go over them. So the process takes about 1 to 2 days to open an account. All right. We do it electronically, send you an application, you fill it out. Takes 2 days to get the account open. Funding part is the longest part, and the part where you have to contact your custodian, make sure that whatever it is you're investing in is in a cash position. Make sure that whatever IRA or whatever you're doing, you liquidate it, you leave it in your IRA as cash, and it gets moved over to us as cash. Okay? Or like I said, if you're working with another custodian, you're not happy with them, you could always transfer in kind to us. Okay? Last step, we do compliance on every investment. So we make sure that whatever you are investing in, we make sure that it is something that can be held in a self-directed IRA. So you want to give yourself enough time to make the investment, to make sure it gets funded, to get the account open. Okay. There is a right of rescission on every investment. So 1 week from the day you sign that application, you have to change your mind. So you can get the account open. We can start process of helping you fund your account, but there will be no investments made in that first week period. Okay. So all in, you want to give yourself at least 3 to 4 weeks to get everything done to be safe. Okay. It's not to be something I can do in a week for you. Okay. I wish I could, but I can't. Okay. So if you have any questions, I will put my information in the chat. Guys, again, if there's anything that is interest to you guys or you have an idea already, let me know. 2 ways, either retirement money or contributions. Those are the 2 ways that you can make into do an investment. Now, again, not everything has to be, millions of dollars to do investments. Some people do crypto, some people do precious metals. You don't need a whole lot of money to do investments. You just have to make sure you have that money. So again, any questions, you need anything, please let me know. I appreciate you guys, and thank you for your time.
All right. Great stuff. Thanks, Jack. Really appreciate it.
My pleasure.
Great. That was great. I always learn something new. I do a lot of these. Every time I learn something new. So that's the goal. It's just education. I'm always learning new things outside of our industry and within our industry and try to align myself with other professionals who are bringing, you can't be an expert in everything, right? So I need good professionals like Jack and vendors that we work with on our side to make everything work. All right. So now we'll get into the fun stuff about actual deals. So these are some recent deals. I think we have about 4 or 5 of these to go over. These are actual deals that we've done. I think every one of these we've closed on. Some of them might even be available. I have to check on that. But if you're new to our webinar and we're just getting your email for the first time, I'll be getting a recording of this so you can actually go back and look at everything again to see if you are interested. If you have any questions, give me a call or shoot me an email. So this one is a unique thing we do, and most of it's Hawaii. Hawaii is very unique. I've got a very stable market, high cost market, long-term, solid appreciation. We're like high cost market similar to like Florida, and we get the run-ups of California, but we don't see a lot of the major pullbacks a lot of mainland markets do. There's obviously a lot of reasons for that. But the big thing about Hawaii is a lot of our value is built up in the land. So on an average, back to this example, average single family home, $1 million on Oahu, a good 70% of that, maybe even 80% of it's land value. The structure itself isn't a whole lot. It's all land. So we position ourselves in Hawaii to be one of the few land lenders that come in to land and land in certain stages because we know that's where a lot of the intrinsic value is. A lot of lenders don't like to lend on land because, vast deserts like, Arizona or Phoenix and Nevada. And it's like, well, we're going to go out and just buy, 200 acres and then cut it up into all these subdivisions. All of a sudden the market crashes. It's completely different than in Hawaii if you're buying infill lots or not. lots with maybe even, or I wouldn't even call them lots, but a lot of our lots here are based on square footage. You get into the acres, I mean, that's big bucks, right? Depending on the use of it. But bottom line is a lot of the value in Hawaii is built in land. But when we underwrite it, we still want to understand, like, what are they doing with it? What's our exposure as far as from the development? Are they trying to get it rezoned? That's riskier, things like that. On a lot of these, like this particular example, this was actually a lot in an established subdivision. This one was a reverse 1031 exchange. So we had a client on the mainland that was actually buying a property in Hawaii as an investment, buying this parcel of land. Homes are coming up already, high-end neighborhood in Kamuela on the Big Island of Hawaii. A reverse 1031 exchange, for everybody not familiar, is when you are acquiring your replacement property first before selling the old property. So a typical 1031 exchange, or also called forward 1031 exchange, is when you sell your existing investment real estate and then you're going to reinvest that gains into another property within a certain period of time. And then you're going to kick the can down the road as far as capital gains. Reverse 1031 is the opposite. You buy the replacement property first, and then you sell your dispositioning property later as soon as you can. The problem with reverse 1031 exchanges is that most lenders don't like to do it because you need to structure it to be what's called non-recourse, where there's no personal guarantee. So we'll look at it on case-by-case basis. This did it non-recourse. All the values in the land. It's strictly land. The borrower is actually very, very strong from both credit, risk standpoint, income standpoint, everything. And this property is already in a developed subdivision. Everything's entitled. Zoning is there. He needed the loan to acquire it now while he waits on his other property to sell. So he bought it for $800,000. We lent him about $545,000. And basically, yeah, this one was 13% rate. So this is providing our capital investor a 10.4% annualized return and fully performing. So that's a common example. This might be on the higher end of loan to value for land, but we saw compensating factors in this that made us comfortable with that. And he's been a great borrower, great client and friend. So this particular property, also on the Big Island, different side. This is Keao. This is on the Hilo side. This property we appraised at $385,000. We lent the borrower 60% of the value. We call it like last mile financing. Basically means the borrower already had a loan, but they're trying to push the project to get to the finish line. She needed a little bit more cash, but she was almost there. We took out the first mortgage, lent her a little bit more cash, got her to finish the project. We actually held back the cash out, and this was only like, I believe, like 30 or 40 grand. We held that money back actually though. So what that means with a holdback or construction holdback or renovation holdback, that means that we don't just give them all the money up front. In this case, we paid off the first mortgage. So yeah, that money got dispersed day one. That's called our like day one risk factor. But the rest of the construction money we held back and we gave that to her as she finished her construction. So she was just a little bit short on capital, but when we finally gave her the 30 grand or so to finish the project, we were basically reimbursing her for the money she already spent. So bottom line is our total loan amount is 231 on a appraised value 385. Very similar, got a 10.4% annualized return to our capital investor. And this one was a little bit shorter, 6-month term. That's what we negotiated. And her whole idea is she's going to get the property on the market and sell it quickly. She did not need a 12-month loan. So that's why we went that route. All right, so this one was unique. This is back to the Big Island. This is Kealakekua. So it's back on the owner side. He's an existing client. He had a property that was land, and he owed $320,000 on it from what I remember. The whole goal was he had permits. He's actually a general contractor on the Big Island. His whole goal was to build a spec home and sell it, or he's going to refi it. I think it's one or the other. But he needed the construction money to build, but he already owed $322 on it, I believe. So whenever you're doing construction, it's all about what is the property going to look like in the future after it's done. And that will determine how much of total loan size we're going to allocate for it. In this case, because he already owed $320 on the property, the after repair value of just this one property wasn't enough for us to lend him what he really needed, which was about $1 million loan amount size. 300,000 of that got paid off the first mortgage lender, and then the rest minus closing costs was going to be allocated towards construction. That property alone wasn't going to be worth enough for us to do that. The LTV was out of whack. So we said, okay, look, it's not enough. We can't do it. Here's why. What other assets do you have that you're willing to put up for collateral? So this is where we got really creative. Borrower actually owned a free and clear parcel of land down the road in a very good part of town. We ended, okay, well, let's look at it. We got a lien report on it. We got it all cleaned up. Everything looked good. We got title insurance on it. We appraised it. And that gave us the comfortability to lend them the total loan size of $1 million. Because the combination of property that he was going to build on, in combination with land, the extra piece of land, our total completed value and the value of the land as is was going to be 1.8. That's what we appraised everything at. Got comfortable with the comps, could see the marketability of it. So then we came in and said, okay, now we're comfortable lending you $1 million. Our loan to ARV was about 54%. Yeah, right around there. So it worked. And again, same concept. We held back our construction costs and we dispersed that to him in phases as he completes them. So they actually have to do the work, pay for the work, pay the subs, pay for the materials. They come out and say, okay, we finished phase one, Reed. We send our inspectors out and then we verify the work's done. Only then do we wire him that first draw for that phase of the ground up construction. For that one, yeah, very similar, 10.4%. As investors earning over $8,000 a month on this. Right, condos. So condotels, always unique. Obviously, a first destination. Condotels are basically legal short-term rentals. Short-term rentals are highly regulated, but if you can find ones that work for your investment strategy as a borrower, as a real estate investor, you can do very well on them. So this particular property was an existing client. It was an acquisition. We valued the property at $550,000. We basically, pretty straightforward. We just lent him $406,000. He brought in almost 30% for down payment, closing costs. And this is a 12-month loan. Bar, there was no renovation on it, nothing like that. Basically, the bar just needed to move quick, close quick. And he was an existing client, so we were comfortable doing that. That's why we, of course, did all our underwriting on the project. And this one is creating a net return to our investors of 11%. One thing I didn't mention was exit strategies, how we analyze deals. Because when a borrower gets in, typically they make monthly payments. And then when the loan matures, they got to pay off the whole principal. We have to determine very clearly and really understand the exit strategy and the business strategy for the property. Because we lent somebody $406,000 in 12 months. I mean, they're making us monthly payments of $3,700 plus, but in 12 months, they have to actually pay off the whole principal. So that's called the exit. So the borrower always have to have some sort of strong exit strategy in place. This is typically, they're going to sell the property, they're going to refinance it, or they're going to refinance or sell some other piece of real estate that they own, or there'll be some sort of liquidation effect, inheritance, but those are a little tougher to vet out. Like, it's one thing to say, yeah, I'm going to sell my business. Well, businesses don't always sell quickly, and inheritance, who knows, right? So we like sure bets. Selling a property, pretty straightforward. That's on us and the borrower to understand the marketability, the market for this property, for the project once it's built or renovated. If a borrower says, I want to refinance this after we're done, that's my exit. I say, great. Well, what kind of loan are we going to look at? Like this type? Okay, great. I'm going to pre-qualify you to make sure that we can do that. As I want to know that the borrower has the ability to get out based on that strategy. So somebody comes to me and says that's their strategy and their credit is very low or lower than the requirements for any typical agency, conventional, conforming DSCR loan, any long-term takeout loan, we're going to say, I don't know how you're going to refi, buddy. Like, it doesn't make sense, right? We'll try to help them find solutions, but it's the whole point of we got to know what's our exit because that's how we're actually going to pay off. We don't want to foreclose on properties. That's not our goal. We're not a lend-to-own company. We want our borrowers to succeed and do well. We want our investors to have their principal protected and get paid and earn a very strong yield for their investment. It goes both ways, right? So it's got to be a win-win. That's kind of how we approach things. All right, this one is on Oahu. So where I'm located, this is Hau'ula on the windward side of Oahu. This one was also 2 parcels of land. That's kind of unique as well. Borrower owned or bought one of them with a seller financing note. I don't know, maybe 5, 6 years ago. Seller financing note, for anybody who's not familiar, means that you buy a piece of property, you don't go get a mortgage from a third-party mortgage company like us, and you're not paying cash. You just say, hey, I want to buy this, whatever it is, $500,000 property. I can give you $100,000 down now. Can I make you payments on the $400,000 that I still owe you? And then I'll pay you off in 5 years once I'm ready to get a new loan. It's basically seller financing or a seller carried note. One for title, different definitions, different terms for different states, but it's all essentially the same thing. So she had seller financing on this piece of land. I don't recall exactly how much she owed on it. Then she also owned the parcel next door. So 2 adjacent parcels, and the other one's free and clear. The goal is to provide her a loan to pay off the seller financing, but also give her a little bit of cash to spend some money with an architect and doing legal work to lay out easements and building a road. The adjacent lot was actually it was actually landlocked, but she owned the missing piece. So because she owned both, that's really what's provided the actual value to that landlocked property, is the fact that she owned both. Because now she can allow an easement across her property. Anyway, bottom line is the property, we appraised both properties, but we went really conservative. We appraised the landlocked property at landlocked value, which is very little, but we encumbered both. So protected us. We felt comfortable with that. The borrower was able to get the loan size she needed to do what she needed. And we got a 12% rate of return for our investor on that. On 190,000 investment, that's 1,900 a month. That was a good, pretty strong deal. All right, so that's it for our case studies. Another recap on relationship. I think it made it pretty clear for us. It doesn't matter whether you're a borrower or a capital investor. For us, everything is about relationships, vendors with people like Jack, attorneys. Everything we do is driven by our relationships. Also, like our alignment of interests, a lot of our own company capital, my personal capital, family members' capital, they are alongside the ride with my capital investors. So I actively, personally lend money alongside my capital investors. I have notes on my books. Our company has notes on our books. Many of these deals that when we bring it to you folks, they're already going to be closed. We've already lent them the money. We have it on our balance sheet. And now we're just opening it up to interested capital investors who want to participate. So very much for us, it's ongoing. I've had investors that I've talked to years ago and we just kept in touch and they never invested. And then 2 years later, now they're ready and it works out. So for us, that's incredibly important in the education side of things. And then some of the vendors that we work with, it's important to have a strong team on the back end. It's not just about us. We couldn't do it by ourselves, just only us. We depend on good quality companies and vendors to keep the balance on the ship. Everything needs to align together. So of course, we got banking, we've got CPA services, fund administration. These are all third-party companies that help. It's all about double checking each other, right? Loan servicing. So I did mention that we manage all the servicing in-house. We actually outsource the servicing to FCI, which is a large loan servicer for private loans in California. But we manage FCI. We still have to keep on top, double check payoffs, double check construction draws, things like that. But they're licensed in, I believe, all 50 states. They help keep us in line with any of the servicing side of things. Side note, capital investors don't pay for that. We cover those costs. That's within part of our fee. And we have attorneys across the country as well that help us both with securities, litigation, if it ever came to that, as well as real estate law. This past weekend, my son, I have 2 boys, both play baseball. They're 5 and 8, but my 8-year-old had a baseball tournament. It's called a Kaizen tournament. So Kaizen is Japanese term. It basically means continuous improvement. I thought that was interesting that we're doing that at the same time. And right now I'm kind of planning out my year for all the conferences I'm going to attend next year. Most of these conferences are on the mainland, so it's tough for me to do, especially with all the activities with the kids and whatnot. But I do make it a point to attend conferences, to see my vendors, build relationships with new vendors, see my attorneys face to face, talk to other debt fund managers, other mortgage companies on the mainland in different markets, see what they're working on, see what risks they're seeing, see how the environment's changing. So that's very important to me. Being in Hawaii, we often can feel a little bit isolated. It's more challenging to get out there and do that, but I think it's very important. It's always been a good investment. That's how I've been actually referred to people like Jack and others and attorneys. So we're always constantly improving on our side, on the operations side of our business. And that's very, very important to us. All right, folks, so that's about it. If I can help with anything, feel free to reach out, give me a call. This is our main office line. Shoot me an email. Again, generally first steps, we just have a quick suitability call, see if this is right for you in some way, shape, or form.
Again, feel free to reach out to me if you have any concerns. Discuss it.
All right.